Now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it's Tuesday, December the 2nd, kicking off the month. It's also the day that QT ends, right? It's the end of QT today. So again, lots of stuff going on. Liquidity in the market, certainly a concern. And of course, we're starting to work through this initial kind of 2 weeks of December. As we noted yesterday, the first 2 weeks of December tend to be a little bit sloppy. So you had a little bit of a sell-off yesterday in the markets, nothing major. But, you know, markets are going to try to rebound a bit this morning. Again, albeit it's going to be a little bit weak and sloppy over the next, really kind of week or so as we kind of go through these mutual fund distributions. And then historically, that sets up the end of the year. Now, as I said yesterday, not every December is positive. In fact, last year we had a negative December. Now, the good news about that is that it's rare to have two negative Decembers in a row. Doesn't mean it can't happen, but it's very rare for it to happen. So there's some decent setup here again. Markets are a little bit long in the tooth. We've had 6-7 months of just positive upside here in the markets over the course since really the April lows, which has been a consistent rally. So we're getting a little bit long in the tooth in terms of monthly rallies, which could suggest some weakness in early part of next year. But right now the setup again is kind of in favor for the bulls right now. But again, we'll see how this plays out. Again, continue to expect some sloppy trading here over the next week or two as mutual funds go through these distributions. But that should be, fairly mild. We'll see kind of where it kind of all settles out. But again, they'll be taking gains out of a lot of their winners, rebalancing those positions back to target, doing tax loss selling. So again, there's going to, you could see some movement in some stocks that you own because of what's happening behind the scenes. So we'll see how this all works out. But again, nothing to be overly concerned about. And we'll talk a little bit more about the markets here in just a minute. Outside of that, of course, retail sales. We're starting to get some early indication of retail sales coming in from the holidays. It turned out to be pretty well so far, right? These are early indications of the amount of sales that occurred over the Thanksgiving holiday break. It used to be Black Friday was one day, and it was actually on Friday, and then now Black Friday, starts like 2 weeks before Thanksgiving. But nonetheless, the sales numbers seem to be pretty good. In fact, a couple of indications come out that retail sales for this year was a record high. Again, these are early indications, and what will eventually matter is the actual retail sales data. Now, it's not uncommon for the actual retail sales data from the government to be different than what some of these independent surveys are. But again, right now these independent surveys are certainly suggesting a bit stronger retail sales. So that suggests that the consumer's still hanging in there, despite concerns about, the consumer having rising defaults and this type of stuff. They were apparently outspending. My wife and I were driving around, on Thanksgiving, and the mall was completely packed, right? So, not on Black Friday. We were out driving around, and the mall here was completely packed. So there were clearly, maybe they were all window shopping, but there was clear. And I honestly, I have no tolerance for massive crowds. I just don't see any joy in going to the mall and fighting the crowds to buy stuff. But hey, to each his own, and we need you. We need you out there fighting the malls. Of course, there was a article out yesterday. Apparently, Target has now ticked off a lot of consumers. Again, they were offering these swag bags, and the first 100 people that showed up would get these swag bags, and people were lining up early, like at 2 o'clock in the morning, to get their ticket so they could get this swag bag. And apparently, these were very, very disappointing for people that stood out there like at 2 o'clock in the morning trying to get in line first to get these swag bags in the freezing cold. And
the first 100 up to the front door of a Target store?
Yeah, no, if I'm going to go get a swag bag, right, if I'm going to wait out in line for something, it's not going to be at Target.
Better be a new car.
Or, go to Best Buy, get a television, whatever it is. Yeah. But I'm not sure it's going to be Target where I'm hanging out at 2 o'clock in the morning. But anyway, We'll see how it reflects on Target stock price in the next few days. Anyway, all right, let's talk a little bit about the markets here. This is what you need to know before the bell this morning. So yesterday, like I said, markets were just a tad weak. We did finish up off the lows. So we opened weaker this yesterday morning. We did finish back up off the lows, which is good. Still on a MACD buy signal right now, so momentum is back on a buy signal, so that's good. Relative strength had gotten a little bit overbought on that kind of 5-day rally that we had, over last week. So again, not surprising to see a little bit of sloppiness. We're well above the 100-day moving average. We had bounced off that support very nicely going into the Thanksgiving holiday trading week. Money flows had turned back positive a bit, a little bit weak yesterday, but again, we're starting to see a little bit of a basing here across the board. So again, we talked about this kind of sloppiness in the markets over the course of the next couple of weeks. Given this rally, that wouldn't be surprising at all. So again, just kind of keeping a watch on this as well. We're seeing this in the same kind of setup in the NASDAQ also. Nice little momentum buy signal from a decently oversold level. Relative strength got a bit overbought. So again, a bit of a correction yesterday. Wasn't surprising, but very much the same setup that we're seeing in the S&P 500. Not surprising because basically the top 10 stocks are the same in both sides. But the bigger issue that is, of course, kind of grabbing headlines right now has been Bitcoin, which has been under a lot of pressure lately. A lot of articles getting written right now. It's like, oh my gosh, what's going on with Bitcoin, et cetera, and certainly a lot of concern. But again, this has been a fairly decent correction in Bitcoin. Bitcoin is getting decently oversold, back on a buy signal. Now, here's the thing about this is that we're starting to see some activity that suggests we might be forming a base here in Bitcoin to set up a decent trading opportunity. I'm not saying you should go out and buy it today, but again, we're starting to see some activity occurring kind of below that. So, options have been picking up here a bit. We're starting to see some more bets on the long side of Bitcoin and option strategy. We're starting to see, we had 4 weeks of outflows during this decline. We had 4 weeks of outflows coming out of Bitcoin ETFs. We're now starting to see inflows back into ETFs as of last week, and we're also starting to see money flows turn back positive. So this is all after going from a decently overbought condition that we had back in early October. You've corrected a vast majority of that. You reversed money flows dramatically here, so you cleared out a lot of the weak hands in Bitcoin. So this is decently setting up an opportunity here for a trade. Now, I'm not suggesting that Bitcoin's about to go roaring off to all new highs, but I'm just saying from a technical condition, if you're long Bitcoin or if you're trading it, there's a decent setup here. I would give this a little bit more time to base here just to make sure that this base holds. But if you can get this base to set up here, and again, we do have very slightly here rising bottoms. If you can get those rising bottoms to maintain in place and then kind of break out of this little trend channel that we're in, that sets up a decent trade back to the 100-day moving average. And that's a decent rally. That'll put you back up to about 107,000. Closing yesterday or this morning, we're about 87.5. So, that's a decent trade here in the short term for Bitcoin. And just something, again, there's been a lot of conversation about what's going on with Bitcoin, MicroStrategy, et cetera. And again, just from a technical perspective, the setup seems to be a little bit better. But across the board, markets are continuing to look to be in pretty good shape. Even, we're keeping a watch on the dollar. The dollar has been kind of, after this rally, has been kind of basing here nicely, starting to work off some of that overbought condition that it picked up on that rally. So again, if the dollar can firm up here, hold this base and rally up above about 101, got a potential move there higher in the dollar. That weakness in the dollar, though, has been also helping support this kind of short-term rally we've had in gold. Gold has had a very nice pickup. We had the sell-off in the dollar just very slightly. Of course, weakness in the dollar is kind of inverse correlation to gold. So we saw gold kind of pick up here off the bottom, triggering a buy signal here. So you've got a nice little kind of rising base, double bottoms, and then a pickup here. So again, that's all kind of playing across the board right now. Again, we're starting to see, the kind of that risk on kind of mentality starting to pick up across asset classes. So after that period of weakness, we're starting to see investors kind of coming back into the markets in various asset classes, trying to pick up the risk, kind of that risk premium, particularly as we move into the end of the year. So that's what you need to know before the bell this morning. All right, we'll come back. We're going to do live Q&A today, so we'll take your questions. Leah's joining us in the studio this morning to help filter through your nonsense that's normally in chat. So if you'll ask questions, we'll be more than happy to answer them live this morning on the show. We'll be right back.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
What's the future of investing in 2026? Gain insights on how AI, technology, and the economy will shape your money in the year ahead at the RIA Economic Summit, January 17th at the Royal Sonesta Houston Galleria. Join Lance Roberts, Michael Leibowitz, and Thoughtful Money's Adam Taggart, plus top minds in AI, crypto, and retirement strategy for a powerful look at the markets of tomorrow. Seats are limited. Register now at realinvestmentadvice.com. realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, welcome to the show this morning. All right, a couple of things. We've had a pretty good run of ticket sales for the upcoming summit, January the 17th. So if you haven't gotten your tickets yet, I certainly encourage you to go get your ticket here sooner rather than later, simply because there is very limited seating. This is a live event in Houston at the Royal Sonesta Hotel. We've got a block of rooms set aside if you're traveling in from out of town. We've got a block of rooms set aside for you. Also, too, we have a mixer the night before, so if you want to come hang out with Adam and me and the speakers, Michael Leibowitz, and just visit. We've also got a special event set aside for that Friday evening. But tickets are all on sale right now on our website. Simply go by realinvestmentadvice.com, click on the banner at the top, and your ticket options are available for you. Ticket prices will be going up at the end of December also. So again, if you get your ticket now, you also get a better discounted price. All right, so live Q&A. If you have questions you want to ask, Leah has been gracious enough to come in this morning and monitor through your chat and try to pick out questions, and I'll be more than happy to answer those for you. Just doing something a little bit different, just to, instead of just me rambling up here every day, actually answer questions that are important to you. So do I think the 4% rule and the classic 60-40 split in retirement still makes sense in today's world? Look, there is no perfect allocation for anybody. Historically speaking, going back 130 years, the 60-40 allocation has beat, hands down, every other asset model, being 100% long equities or anything else, because it reduces volatility, creates income, and creates total return for portfolios, which works to your benefit over time. So again, the allocation model is about reducing beta volatility. That's why you own bonds. So in any portfolio, your goal is to have all three legs of the stool in place, which is capital appreciation, dividends from stock, and incomes from bonds. The benefit that bonds give you in that allocation is guarantee of principal. Now, again, we're not talking about owning bond ETFs. So when you're talking about the 60-40 allocation, if you're buying bond ETFs, you are eliminating the one reason to own bonds, which is guarantee of principal. Because at maturity, those bonds come back to you at full face value, regardless of if I own a portfolio of 60-40 bonds and interest rates go to the moon, which is everybody's fear, the principal side of my bond allocation will go down in price while I'm still collecting the yield on those bonds. So I'm still collecting the income. So if we've talked about before on the show, if I just break a portfolio in half, right, and say 50% stocks, 50% bonds, and I put 50% of my bonds into 10-year U.S. Treasuries that are paying 4%. And if my goal is every year to generate a 6% rate of return, well, immediately I've already got 2 of that 6% just coming in from the income from the bonds. 50% of 4% is 2%. If my portfolio has a dividend yield of 2%, S&P yield, then I've got another percent coming in from dividends. So already, just by building that portfolio, January the 1st, I already know that I've got 3 of my 6% already intact. Now, if interest rates go to the moon, I'm still getting my 4%. Yes, the bond value side of my portfolio will go down in price because interest rates have gone up. But as those bonds mature, I get all my money back. I don't have to worry about that side of my portfolio. So why would I not want to own a 60-40 allocation? Now, there's been a lot of conversation in recent weeks. In fact, I wrote an article about this. Jeff Gundlach and BlackRock had come out and said, oh, you should put Bitcoin. Instead of 60-40 bonds, stocks, and bonds, you should have 60% stocks and say 20% bonds, 10% Bitcoin, and 10% gold. Okay, that's fine, except gold gives me no guarantee of principal. It also gives me no income. So let's go back to our theoretical model, right? So now I've got 50-50 in my portfolio. Let's say that I put 25% in bonds and 25% in gold, just easy math. Well, I just turned my income, my guaranteed income stream that I was going to generate to make my 6% rate of return, I've now cut 1% off of that because I've reduced the amount of bonds that I own in my portfolio. So I've cut my income because gold doesn't pay an income. Now, I'm hoping that the price of gold goes up, but there have been very long periods of time where gold hasn't done that. So again, I'm impacting the one side of my portfolio. The reason that I own the bonds in my portfolio is to lower the volatility of my portfolio. So now I put a volatile asset of gold in my safety bucket, right? And if it doesn't go up, I've got more volatility. So I've increased the volatility run of my portfolio overall, which weighs on my emotional bias as I'm going through life. But then I also decrease my guaranteed income stream. So now my 6% is more dependent upon volatility rather than guarantee of income, which is, again, it just depends on what you want. But now let's slap some Bitcoin in there as well. And now not only have I massively increased the volatility of my portfolio by adding Bitcoin to it, I still have reduced the guaranteed income stream. I've also reduced the guarantee of my principal being repaid to me in the future. So again, how you approach, so again, I'm not debating whether or not you should own a 60-40 or not. That's really a personal choice. I'm just saying that we have to understand why the 60-40 allocation has been so successful over the last 130 years. And why it's beaten every other asset class hands down is because in rising interest rate environments and falling interest rates environments, it has outperformed over time. Over time. The key word is over time. Not over the course of a year, not over the course of 3 years. We're talking about over the course of 100 years, right? We're talking about over the course of 20-year spans. We're talking about over the course of 30-year spans. Your investable lifetime, 60-40 has done better because of one reason and one reason only. It reduces volatility. So your drawdowns are less, which means that when markets start gaining ground again, you don't have as much to make up on the loss side. So again, whether it's 60-40, 70-30, 80-20, the important thing to remember is that whatever allocation that you want to capital preservation, that should be in bonds. Very safe bonds, right? AAA, AA, single A, triple B corporates, stay away from junk. Because once you get into junk bonds, that's basically a risk asset. So you just think about start just thinking about your portfolio as a function of safe money, a safe money bucket that's going to be there regardless of what happens, and your risk bucket. So gold, Bitcoin, stocks, emerging markets, private equities, private credit, high yield bonds. That's all in your risk bucket. So when you're thinking about your allocation and how you want to set it up for yourself, think about your portfolio as two buckets. One, my risk bucket. That's if everything goes great, I'm in great shape. But also consider what happens to your risk bucket if everything goes wrong. Because can you recover from that? And in that moment, when you have that risk bucket go wrong, which it does from time to time, you'll be glad you had the safe bucket. So again, just something to think about. All right. Does having high and growing GDP to debt ratio threaten the dollar as a world reserve currency? So first of all, the debt to GDP ratio is declining. It's not rising. And that's because GDP growth is growing. And we're having fairly decent growth right now in the economy. But even if it was growing, it doesn't threaten the reserve currency of the world because from a debt perspective and an economic growth perspective, the U.S. is still the strongest country in the world. And again, the US dollar is the de facto reserve currency and will be that way for a very long time because there's no other currency you can go to. It's about depth of liquidity. It's about military strength. It's about economic stability. It's about the rule of law, which is missing in every other country. So there is no threat to the dominance of the US dollar right now. Now, is the dollar, as a few years ago, like 40 years ago, the dollar was about 60% of all trade globally. Today, it's about 53%. And that's because China has grown as an economy. And so as their economy has grown and they become a much larger power globally, the yuan has become a larger share of transactions, but it's only about 10% of global transactions. So that's eaten into a little bit of the dollar being in global transactions, but as a percentage of reserve currency, it's still about in actual FX transactions. The US dollar is still about 80% of all transactions. It's a very, very high percentage. And there's just really no alternative. So all these stories and narratives about, and we've written, and I encourage you to go to our website, go to realinvestmentadvice.com and just type in dollar, reserve currency, anything in the search bar at the top. And you're going to see numerous articles that Michael and I have written, both just kind of debunking this whole narrative of the death of the dollar and the dollar debasement. And all of it's not true. There's very little factual, these people that are promoting these myths of the decline of the dollar and everything else there's not a factual basis to most of their arguments. It's just them trying to promote fear to get you to buy gold for whatever reason and doesn't have a lot of basis behind it. And so we've written a lot of articles. I don't want to spend all day going through that whole narrative, but I did think it was interesting this morning because this is one of the big problems with this whole argument. And let me see if I can find this chart here real fast. Yeah. So this was a graphic that was put out this morning. Brent, if you can bring that up for me. Purchasing power of the US dollar. This is the whole narrative to the story. It's like the decline of the purchasing power of the dollar. It's just been terrible. And you can see, right, there's the chart, right? So back in 1913, the dollar bought $1 worth of stuff. Today, it buys about 10 cents worth of stuff. It's like, clearly the dollar's dying. No. This is a completely, what should I say? This is a chart crime of massive proportions. Because what this assumes, and this is what they don't tell you, right? This is the story, right? To see, you've lost all this purchasing power in the dollar. Yes, you have. If you have lost purchasing power in the dollar, if in 1913 you took all your dollars and stuck them in a jar and stuck them underneath your mattress. Yes, if you pulled those $1,000 out of your mattress from 1913 to present, and went to go spend them, they're not going to buy you what they bought back in 1913. Why? Because of inflation. Well, see, there you go. You have inflation. This rampant inflation has caused the death of the dollar. No, that's not true either. If we don't have inflation, let me rephrase this. If the dollar today bought what it bought back in 1913, you would not be enjoying the lifestyle that you live today because that dollar, that erosion of the dollar is a function of economic growth. If you didn't have a declination in the dollar, you would have had no economic growth since 1913. In other words, we'd all be running around in Model Ts and trying to figure out how to get our corn to market, right? We've had economic growth, industrialization, all these things that have led to stronger economic growth, which has led to higher inflation. You only have inflation when you have economic growth. So what all these charts that they put out there assume is that there's been, you've just had your money sitting in a jar. You never invested. You didn't buy gold with it. You didn't buy stocks with it. Hands down, by far, if you had invested your dollars in any asset class, by far, stocks have been the best asset protection in terms of inflation adjustment over time. To protect your purchasing power parity of your dollar, hands down, without any close resemblance by miles of any other asset, it's been U.S. equities. Not foreign equities, not, bonds, anything else. If you really wanted to protect, now other asset classes have done well. Gold has done well. Stocks have done well. Bonds have done well. Investing in anything, real estate, if you'd invested those dollars in the jar in anything other than just leaving them in a jar, you would have protected your purchasing power of that dollar. So your dollar would buy you as much today as it bought you back in 1913. But this is what they don't tell you. Just a good example. Here was a chart this morning. Let me see if I can find this one really fast. I don't want to dawdle too long here, but because we got a lot of questions. Thank y'all for so many good questions this morning. I'm going to try to get to as many as I can. I'll move faster here after this. I may not be able to find it. Anyway, it was a really good chart. Oh, you know what? I posted it on X. That's where it is. One second. Here it is. Thank you. You can grab that chart for me, Brent. Okay, so sorry for the delay there. I was trying to find this chart. This was a chart of just showing, and this is my point, right, that I'm trying to make, is making sure that you're investing your assets. This is a chart of returns since Chat GPT's release, right? So where was the best investment for your money to grow your purchasing power over time, just since the release of Chat GPT, which was 3 years ago, right? Magnificent Seven by far, silver, gold, and then you get into, farther on the right-hand side, bonds, sovereign, oats, buns, treasury, gilts, U.S. oil way over there on the right, it's lost you money. So it's important to understand, where you're investing money. But over time, regardless of what asset class you're in, stocks, because they're a function of economic growth, tend to outperform. So again, you dismiss a lot of these narratives about the end of the world, the end of the dollar, because there's just not a lot of basis behind them. Okay. See if I can I'm going to start moving a little bit faster, because otherwise I'm going to be here till 2:00 in the afternoon with you guys. Lance, what's been my greatest investment mistake and triumph? Biggest, I guess from investment triumph, right? What's been my best return investment? My house. I've done very well selling my houses, and I get ribbed about this a lot, is that I've just been very lucky with my houses. Like, I bought a house at the bottom of the market in 2008, those type of things. I've just been very lucky with that. So like a lot of my best single investment returns, I invest in stocks, I invest in bonds, I invest in all the stuff. My money's invested with our clients in our same portfolios. But just talking about percentages of returns and magnitude of returns, I get ribbed a lot, because I've forced my wife to move about every 3 years, because I'll buy a house and some guy will come up and knock on my door and say, will you sell your house? And I'll go, yeah, for the right price. And they'll give me my price. And it's just been weird. So my wife is very upset with me most of the time, because I'm forcing her to move. But, worst mistake, oil and gas investments. I've made a lot of money with oil and gas, but I've also lost a lot of money with oil and gas. And so, boom and bust cycles, it happens. But again, yeah. So, there's been, clearly, anytime you're investing, you're going to take losses. And my biggest losses have come either in commodities or in private equity. Those have been the two kind of biggest losers over time. And again, that's just a function of investing and why you have to control risk. But, again, this is why also, I work on very much diversifying my assets across, different asset structures to mitigate those impacts, because something's eventually going to go wrong, right? It's just a function of time. But there you go.
Do I think Bitcoin 4-year cycles narrative is still alive, putting additional pressure on Bitcoin? There's all kinds of cycles for everything, right? You have 7-year cycles, 14-year cycles, 21-year cycles, and they make sense. And there's certainly a rhythm to assets, and whether it's not just Bitcoin, it's also stocks, it's also everything else in life. There's a natural rhythm to things that go on. The problem with cycles is that, again, from an investment standpoint, it's working through that cycle and staying alive through it. And what I mean by that is that there's a lot of once you start getting longer term cycles like 20-year cycles and 30-year cycles of markets, emotionally it's very hard to stay through that cycle, whatever it is, staying out of it. As an example, so let's just say, for example, let's just take Bitcoin. Let's say that we're in the 4-year cycle and we're now on the downside of the 4-year cycle. So we're going to have 4 years of down market in Bitcoin. It doesn't mean that Bitcoin's going to go down for 4 years. I'm just, and again, just stay with me for a second. This is purely hypothetical, right? Bitcoin, even if we're in a 4-year down cycle of Bitcoin, well, I'm not saying we are. Again, for people watching the video later, I don't want emails. Oh, he's a Bitcoin hater. No, I'm long Bitcoin. It's okay. But just say we're in a 4-year down cycle for Bitcoin. It's not going to go down for 4 straight years, right? Every day is just not going to be down. You're going to have it could declinate over time. And when you look back, it's like, yeah, there was a 4-year down cycle, but there's going to be some tremendous rallies in that. So again, like I was talking about this morning in our Before the Bell segment, there's a nice little setup for a trade in Bitcoin. And so, so trade the opportunities as they exist. And again, even when we manage our own portfolios, we may be long a position that we're going to hold a very long time. So for instance, we've owned AbbVie ever since we launched portfolios. As an example, we love the company, but we have bought and sold that position. We have increased and reduced that position. We've never sold it entirely, but we've increased and reduced that position over time because of the cycles that stocks go through. So when we see we talk about sector rotation, those type of things, we're moving that sector rotation around within the portfolio as well. So again, I would worry less about these big macro cycles because emotionally we fail at remaining disciplined in that environment because we're in a 4-year down cycle or 4-year up cycle, and I'm going to be long. It's easy to be long something when it's going up. It's very tough to be out of something or in something when it's going down, right? So because you're going to have these big rallies and it's going to suck you back in potentially right at the wrong time. So again, just be careful with these narratives again and focus on what markets are doing near term because we can manage that much better. Emotionally, psychologically, behaviorally, we can manage, 3-4 months ahead of us. But, when you're starting to try to look out, 4, 5, 6, 7, 10 years ahead of you, that's a very difficult way to manage money. What's the best investment for a starting out investor? S&P 500 flat, hands down. Why? Because the whole point when you're starting out investing is to learn how the market works. And everything you're going to watch, see, read, hear about is going to be about the S&P 500. So, we've used this example before about breaking down a car. And like if you've never seen a car, right? You just came from another planet, never seen a car. I take you into a garage and there's a completely disassembled car in the garage. And I say, hey, go put it together and you'll have a car to drive. You have no idea. You've never seen the car, right? You don't know what part is what, right? So go look at the car first, right? So if you want to learn how to work on cars, you go drive a car, you understand the car, you understand how it operates, what makes it move forward, backwards, etc. Same thing with markets. Get an S&P 500 index fund, invest in that, watch what's going on in the world around you, see what makes markets go up, see what makes markets go down, see how the S&P 500 reacts relative to all of this, and learn that. And then that way it's much easier then to start breaking it down then you can start breaking the S&P down into sectors. Learn how those sectors work within the S&P 500. Then you can break it down into the individual stocks within those sectors within the S&P 500. once you understand how markets work, what causes volatility, what causes stocks to go up, what causes them to go down, what economic reports are important, what ones aren't, what narratives are valid, what narratives aren't valid. Once you learn all of that, then you can start moving down into all the other areas, right? Because now you understand how the car works. So now you can take a car, you can break it down into its parts, you can put it back together. And then once you really understand that, then you can start understanding how to start tweaking the car to increase better performance. And you can do that by adding small caps and mid caps and these other types of investments. So again, I always highly recommend to people just starting out, just dollar cost average into an S&P 500, learn what makes it work, and then everything else becomes a whole lot easier once you understand that dynamic. What roles should REITs play in portfolios over the next year, 5, 10 years? It's all about interest rates. So if, again, nothing wrong with REITs. We own real estate in our portfolios, and you should. And in fact, we have a portfolio. So if you go to SimpleVisor, one of our thematic portfolios, just talking about starting out investing, we have what's called an accumulator portfolio, which is specifically designed for investors just starting out. And it does have small caps, mid caps, large caps, and it's got a diversification, but there's also REITs in it. And the reason is they pay higher dividends, and they perform over time because they produce it's real assets underneath it. But they are interest rate sensitive. So if you're in an interest rate up cycle, they're going to underperform. You're still going to collect the dividends, right? But you're going to be impaired by rising interest rates. Now that we're back into a falling interest rate environment, REITs should start to perform better over the course of the next few years. So again, yes, I would certainly have some type of real estate exposure, either directly in real estate or indirectly through REITs or what other type of investment vehicle that you want. Particularly if rates are going to go lower over the next few years. Is there a trade for money rotation between the Magnificent Seven and people trying to pick winners? I'm not sure I understand the question, but the Magnificent Seven is a function of two things. One is that it is a function that they are also generating the most revenues. In fact, I just posted a chart on this morning talking about this. The Magnificent Seven right now is this is the top 10 stocks, but that's technically the Mag 7. The top 10 companies right now make up 40% of the S&P 500 index. It is a very large percentage of the index. Now, this is a function of two things. The first big driver of this problem is passive indexing. We've had a massive flow into ETFs over the course of the last 4 years in particular. And over the last 4 years, we've also seen a massive proliferation in ETFs. We've had a massive surge of ETFs being issued. And so whenever these ETFs are being issued, whether they're on leverage or wherever, every dollar that goes into those are fueling these same stocks because these stocks are in all those passive indexes. It's also people chasing those markets. And importantly, the reason they're chasing those markets is because outside of everything else, the bottom 493, small caps, mid caps, which they are not producing earnings growth, this is where all the earnings growth is coming from. Brent, if you can bring this chart up for me. This is forward and trailing earnings per share for the Mag 7 or the top 10 stocks. So this is, if I'm buying companies that are growing earnings, this is where all the earnings growth is. So again, there's really two things that are driving that. But again, that's kind of the key issue. What do we think about dated maturity bond ETFs like Invesco Bullet Shares, 2030 corporate bond funds? I don't like them. There's a variety of reasons. If you're going to buy bonds, go buy bonds. Anytime you buy an ETF, you're subject to a lot of other issues that go along with ETF issuances. Just go buy the bonds. Just go, if you're going to buy a 30-year duration, go buy a 30-year treasury. Put it in your portfolio. It doesn't matter what my maturity is that I want. If I want to buy a 10-year treasury that matures in 1 year, I can do that, right? So I can create my own bullet shares in my portfolio they're fine, right? If you don't have the ability to go out and buy bonds, you want to try to do it on your own, and you don't know how to buy a bond and how to analyze the maturities and those type of things, bullet shares are fine. But again, you're giving up the one real reason to own treasury bonds, which is that guarantee of principal and that income stream. And again, just you'll do better over time just going and just go to your brokerage firm, Fidelity, whoever, talk to their bond desk and say, I want to buy some 10-year treasuries. I want this duration in a 10-year treasury. I want 5 years. I want a 5-year duration in a 10-year treasury, and they'll buy it for you, right? And put it in your portfolio. It's not hard. If you still don't know how to do that, go find somebody who can do it for you and do the work. What do you think about yield curve inversion, steepening near 0.8 to 1%, which has typically been when a recession arrives? The whole issue of a un-inversion of the yield curve has been when it comes. So the steepening of the yield curve is not a problem. It's when the steepening of the yield curve occurs after an inversion that is a representation of economic weakness. And right now, we had the yield curve inversion over the last 2-3 years. It was a very long yield curve inversion, and now we've uninverted that. And typically, that's your warning sign that you're getting closer to a recessionary outcome. But again, there's no indication of that right now. If you take a look at recession risk, recession odds, those type of things, there's just not a lot of indication that we're heading into a recession. There's a lot of signs of weakness. Don't get me wrong. Take a look at ISM manufacturing, very weak yesterday, near contraction. I'm waiting for the services index to come out. That'll give us a little bit better indication about where we are. But economically, we're not going gangbusters. Economically, we're not too far off of having a potential, short-term recession, and that's very possible. And that would align with what the yield curve is telling us. But again, just right now as of today, I wouldn't go bet my portfolio on a recession happening next year. Could be year after. What happens to the AI story if CapEx deals do not show up in construction and P&L numbers? They're already showing up. If you take a look at what's going on with the CapEx build, et cetera, it's already showing up in the construction data as well. So yeah, that's already showing up, and that's just probably going to accelerate. What bucket does gold fall into? Risk. It's a risk asset, not a safety asset, because it is volatile. It moves up and down in price. And when you buy gold, you're only betting on the price of gold. Has no income, has no fundamentals, has no everything else. So absolutely, that should be in your risk bucket. Again, owning it is fine. Nothing wrong with it, but it's a highly volatile asset, and it can make you money, and it can also lose you money depending on when you buy it. So again, you're betting solely on a price gain. And you're betting solely on there being more buyers than sellers. And that dynamic changes over time. And if you just go back and look at a chart of gold over time, yes, it rises over time, which is good. But there's also long periods where it grossly underperforms other assets. So absolutely should be in your risk bucket. How to see... let's see, where am I? I lost my track. Oh, here. How are we feeling about small caps for 2026? The problem I have with small caps are fine. There's a couple of problems, though, that I think you have to be a little bit cautious of right now, because the outlook for small caps is extremely bullish. And what they're expecting right now is a massive resurgence of earnings growth for these companies. Now, mind you, about 40% of the Russell 2000 has negative income, right? So fundamentally not great. But there's a lot of bet that there's going to be this massive resurgence, and that small caps are going to have 60% earnings growth rates next year. But the problem I have with that assumption is that over the last 4 years, we had really strong economic growth. They could barely generate any earnings growth. So why is it next year that everybody's betting on small caps to be the winner when the economy is slowing down? Right. So it's, if you couldn't generate earnings growth in the boomer years, what makes you think you're going to generate earnings growth next year? Maybe it's the case. And again, I don't have any problem with you owning small cap stocks. I would just be a little bit cautious and make sure that I own fundamentally strong companies. I think there's more of a risk to the earnings outlook is so optimistic that there's more risk to small caps than there's not. And I would just be careful with it. Again, we own some small cap stocks in our portfolios as well. Nothing wrong with them. We have a small mid in our, and again, in SimpleVisor, we have our thematic models. We have a small mid-cap growth model, own small mid-cap stocks. So again, I'm not opposed to owning them at all, but I think you have to be selective about what you own. When do I think long-term bonds are recovered? They are recovering. They've been recovering now for over a year, so I'm not sure what you're waiting on. But our yield's going to go lower from here. Now, again, a lot of people are expecting like, oh, when are long bonds going to go back to 0.5%? They're not going back to 0.5% unless we're back into an economic shutdown. But as the economy slows down and as you get inflation returning back to 2%, you get economic growth at 2%, inflation at 2%, you're going to be running about a 2%, 2.5% on 10-year Treasury yields. That's about where they should trade. So you're at 4 right now, and wouldn't be surprising that next year, if we see inflation continue to return to Fed target levels, that we see 10-year Treasury bonds trading somewhere in the mid-3s. But yeah, they've been recovering here for a while. You're down from 5 to 4. And you're eventually going to wind up back in the 3s. What's the bull bear case for private real estate and private credit? I would not be chasing either at this moment. The bull case is everything goes fantastic and you make a bunch of money. The problem is that you need to really, really understand what you're doing in private real estate and sorry, not private real estate, private equity and private credit. And right now, if you take a look at what's happening in both those markets, everybody's throwing money at those, and they're trying to expand those markets into the retail market. Why? Because the deals are becoming harder to come by. Good deals are coming harder to come by, and smart investors are going, I don't want those deals. And so they've got to figure out a way to offload the crap deals on everybody else, which is the retail investors. So they need to open this up to 401k plans and everything else. So there's been this big lobby to move private equity into those markets, private equity, private credit, which dilutes your returns, which ultimately, when you do that, you're going to reduce those outstanding rates of return back to fair value, which is going to be more like 6-7% a year, not 10, 12. But secondly, a lot of the valuations, and when I own private equity, I get a statement from the private equity company. That's basically marked to what they think it's worth. It's not marked to what they can sell it for. So, for instance, if I own a chunk of a private company right now, and I'm like, hey, I'm going to go sell this private company today, it may be 40, 50 cents lower than what I've got it marked for on my books. So the reason that people go, well, you want to own private equity because it has low volatility relative to the market. Yeah, it's only got low volatility because they don't mark to market. Once you make it a public asset in 401k plans, it has to be marked to market. So all of a sudden now you're going to increase volatility, lower returns. It's basically going to become an asset like every other asset and probably not perform as well as just owning publicly traded stocks. So I if I was in my 30s, and again, I've been doing private equity, private real estate for decades, right? Personally, you need to really understand what you're getting into. And I've written some articles on our website. So if you go to our website, realinvestmentadvice.com, and just type in private equity, you'll get a couple of articles. But again, when you look at what goes on, the vast majority of deals in private equity, they don't make. It is only, when you hear about people making these outsized returns, oh, this guy bought the private equity of Uber. That's a very small percentage of deals that actually mature. Most of these deals that in these private equity funds don't work as well as expected. You've got to really understand what you're getting into and also understand your liquidity lockup. You're going to lose liquidity for a long time in these funds. And if you don't have a lot of excess capital, I certainly would not be doing it. So again, I'm not against private equity at all. I just think it's very specific and very selective. And it should only be for high net worth investors that can afford to lose a chunk of money or to lose liquidity for a very long period of time because I have plenty of other assets. If you don't have a lot of excess liquidity, I would avoid them because you can have money tied up for years in these things and not be able to get to it. All right, let me see if I can get one more in before we wrap up for the day. There's a bunch. There's a bunch of great questions. I'm just trying to get to one. All right. So how would I? So when is this? We'll wrap up with this one. When is marriage a good investment? And when is it not? Marriage is a terrible investment if you marry the wrong person. I think so. I made this. So full disclosure, I'm divorced. Married. I'm currently on the second marriage with my wife. Yes, correct, Brent. I am on my last marriage with my wife. What went wrong in my first marriage? I married this very beautiful girl, fantastic, terrible partner. Right? Just nothing wrong with her, right? At all. But just not a good financial partner. And what happens too often in marriage is that, we fall in love with somebody, we meet them, we fall in love with them. We have this whole cathexis thing going on right now. It's the pitter patter of the heart. It's the lust. It's all those type of things. And so we start we overlook all of the red flags, right? And this goes both ways, mind you. This isn't just guy to girl, or this is girl to guy too. So, I mean, this applies to both parties. When you're with your mate, and I spend a lot of time with my kids talking about this, particularly my daughters. I spend a lot of time with my daughters talking about this, is that there are certain things that you should want in a mate that has nothing to do with how they look, how they smell, those type of things, right? Are they going to be a good financial partner? Do they have the same values around money and credit? If they don't, I would avoid them, because that is only there's two big reasons why people get divorced. It is infidelity and finances. Infidelity is number one, finances are number two. But guaranteed, if you're having a lot of financial trouble in your household, you're arguing, you're fighting, you're not sleeping together, those type of things, there's going to be infidelity. So people dismiss and they overlook all the red flags about marriage when we're in the heat of the moment. Oh, she's so pretty, he's so handsome, can't wait to be married, it's gonna be great, we're gonna have this beautiful house. If the views are skewed, the marriage is not gonna work. If he's a spender and she's a saver, it's not gonna work. If he's frugal and she's not, it's not going to work, because you're constantly gonna be battling over the finances, which is eventually going to lead to infidelity, which is eventually going to lead to divorce. But if you talk to anybody who's been married for a very long time, you'll find out that it's not about the love, the sex, those type of things. It's about their best friends, and they only want to spend time with each other, no one else. And more importantly, they're on the same page when it comes to their financial agreements. They talk about purchases they're going to make. They don't go buy stuff and hide it in the trunk of their car, that type of thing. You can tell I'm talking from personal experience. But those are the things that I have found the hard way. That's most important about making marriage work. So is marriage? The bottom line is this: is marriage a good investment? Absolutely. It is the best thing you can do with the right person. It is the worst thing you can do with the wrong person. You'll be miserable. So, and again, the right person doesn't mean how they look, how they smell, anything like that. It's, do they have the same values as you do? Are you best friends? Are you able to work through good times and bad times together? And look, this goes down to even simple stuff like, do they pick up after themselves around the house? You're a neat freak and they're not. That is not going to work. Ultimately, it's going to drive you crazy, right? So those are the things. But yes, marriage is a wonderful investment. You should absolutely invest in it. And plus, we need you to, because we have a declining birth rate. So you need to go have babies. We got to increase the demographics, but we need to do it the right way. So, all right, that wraps up the show for the day. Thank y'all so much for so many good questions today. We'll do this again soon. since I can actually figure out now that y'all can stay on topic for a show. This is awesome in the chat. Make sure and like and subscribe to the channel. We appreciate it very much. And like I said, this was fun. Definitely do this again in the future. So anyway, thank you very much for that. Be sure and get by the website, realinvestmentadvice.com. Our daily market commentaries out. Make sure and get your tickets for the upcoming investment summit, January the 17th. You don't want to miss out. AI, crypto, investing, bonds, the economy, financial planning from Ed Slott, America's Financial Planner. Lots of great stuff coming up on that seminar, on that summit, but get your tickets today. All right, have a great day. See you back here tomorrow.